As of the latest market activity on Monday, May 18, 2026, the trading session has concluded with Plug Power stock closing at exactly $3.45 per share, marking a sharp intraday drop of 8.73% as the stock fluctuated between an intraday high of $3.81 and a low of $3.32 on a massive trading volume of over 86 million shares. This sudden downward swing breaks a recent multi-day rally, catching many off guard, especially given the positive headlines circulating around the clean energy sector over the past week. While the casual observer looking at a standard stock ticker might see this as just another volatile day for a notorious high beta asset, the reality buried within the trading volume tells a completely different story. The massive block trades hitting the tape late in the session suggest that institutional players are aggressively repositioning themselves, utilizing the retail-driven momentum to quietly exit large positions or hedge their downside risk through complex option structures. This creates an immediate divergence between public perception and institutional action, setting up a classic trap for investors who assume that the recent price appreciation was backed by long-term structural accumulation. The prevailing expectation in the market right now is that Plug Power has finally turned a corner, a narrative heavily fueled by their first quarter earnings report on May 11th, which showed a 22% year-over-year revenue increase to $163.5 million and a massive reduction in gross margin losses. Retail traders looking through popular individual brokerage platforms or checking trending tickers on their favorite investing sites are operating under the assumption that the company is on an uninterrupted path to its stated goal of positive financial performance by the final quarter of this year. It is easy to see why this belief is so widespread. When a company posts a significant reduction in its cash burn and secures price target increases from several major investment banks, the natural conclusion is that the worst of the liquidity crisis is safely in the rearview mirror. However, a deeper contrarian analysis of the balance sheet reveals that this expectations versus reality dynamic is highly fragile. The apparent improvement in financial health relies heavily on non-operational catalysts, such as the upcoming $39 million asset monetization from selling an investment tax credit, rather than self-sustaining commercial profitability. By relying on short-term balance sheet engineering to meet near-term milestones, the underlying business remains deeply exposed to structural energy market volatility and execution delays. To understand the intense friction driving the daily swings in Plug Power stock, you have to look at how modern retail trading ecosystems interact with institutional liquidity. A significant portion of the daily trading volume is channeled through retail networks like the Robinhood app, where retail fractional shares and speculative options trading often amplify short-term momentum. When positive news breaks, like a price target upgrade to $5 from Wall Street analysts, these platforms light up with activity, causing massive volume spikes in short-term call options. This forces institutional market makers to purchase underlying shares to hedge their positions, creating an artificial upward squeeze that does not necessarily reflect institutional conviction. On the flip side, sophisticated investors managing capital via advanced platforms like the Interactive Brokers trading infrastructure look at the broader macroeconomic picture. They analyze the stock through the lens of rising capital costs and persistent supply chain bottlenecks in the clean hydrogen infrastructure. When these institutional desks see a retail-driven pump that disconnects from long-term capital expenditure realities, they step in with massive short positions or block sales, which is precisely why we see these sudden 10% intraday reversals that leave retail investors holding the bag. The contrast between speculative momentum and institutional reality is further complicated by how modern long-term capital allocates into the energy sector. Wealth managers utilizing automated platforms like Schwab Intelligent Portfolios or building portfolios on corporate networks like Fidelity Investments generally view highly speculative, non-profitable micro or mid-cap clean energy assets with extreme caution. While a self-investing individual might see a $3 stock as a cheap lottery ticket with massive upside, an algorithm managing an intelligent portfolio looks at risk-adjusted returns, debt-to-equity ratios, and the historical cash burn rate. Plug Power has historically diluted its shareholder base to keep the lights on, a track record that acts as a massive red flag for automated wealth management systems and conservative capital allocators. Consequently, the stock is largely excluded from institutional-grade core holdings and is instead relegated to highly speculative thematic vehicles or active trading accounts. This lack of a stable institutional floor means that whenever market liquidity tightens or the broader indices face pressure, speculative assets are the very first to be liquidated, explaining the exaggerated downward moves relative to blue-chip technology giants. When evaluating this sector, it is helpful to contrast how capital behaves when moving into established mega-cap firms versus speculative infrastructure plays.
For instance, an investor tracking Nvidia stock is looking at a company generating billions in immediate high-margin free cash flow driven by an unprecedented global hardware build-out. Similarly, those holding Apple stock or Tesla stock are betting on companies with massive consumer ecosystems, pricing power, and established balance sheets that can withstand prolonged periods of high interest rates. These companies possess the luxury of using their capital for share buybacks or massive research budgets without worrying about basic survival. Plug Power enjoys none of these luxuries. Every dollar they spend on expanding their green hydrogen network is a dollar they must either borrow at high interest rates or raise by issuing new shares, directly hurting existing investors. This fundamental divergence in capital efficiency is why clean energy infrastructure has lagged so severely behind the broader market indices, forcing active market participants to treat every single rally as a trading event rather than a long-term investment opportunity. Let's step back and look at the actual operational engine behind this company to see if the business model can truly support the current market valuation. At its core, the company is attempting to build an end-to-end green hydrogen ecosystem encompassing production, storage, delivery, and energy generation. For years, their primary commercial success was restricted to a very niche material handling business, specifically providing hydrogen fuel cell systems to power forklifts in massive distribution centers operated by corporate giants like Walmart and Amazon. While this business provided a steady baseline of revenue, it was never scalable enough to offset the immense corporate overhead and research expenditures required to build a nationwide hydrogen fueling network. In response, the company pivoted aggressively into expanding its electrolyzer business, which involves selling the specialized equipment needed to split water into hydrogen and oxygen using renewable electricity. This is the segment that drove the recent revenue growth, highlighted by large-scale international deployments, including a 100-megawatt system in Portugal and engineering designs for massive industrial projects in Canada. The core challenge of this business model, however, is the brutal reality of negative gross margins on their fuel delivery business. For a long time, the company was locked into fixed-price hydrogen supply contracts with their material handling customers, but because their own internal production facilities experienced severe construction and regulatory delays, they were forced to buy liquid hydrogen from third-party industrial gas suppliers at exorbitant spot prices. They were essentially buying fuel at a high price and selling it to their customers at a low price, a structural flaw that completely eroded their cash reserves. The recent improvement in margins is a direct result of their internal production plants finally coming online, which reduces their reliance on those expensive third-party contracts. But even with these plants operational, the cost of distributing liquid hydrogen across a vast geographic network via specialized cryogenic trucks remains incredibly high, meaning that true profitability is entirely dependent on achieving massive regional density that simply doesn't exist yet. Please consider your own portfolio strategy and how you approach this volatile sector. Comment below how many shares of Plug Power you currently hold, and whether you are using an active trading platform or a long-term automated account to manage your position. Looking ahead, the future trajectory of the stock will be determined by a very specific set of operational catalysts and structural risks that will put the expectations versus reality framework to the ultimate test. The immediate milestone that the market is watching is the company's ability to achieve positive earnings before interest, taxes, depreciation, and amortization by the final quarter of this year. To meet this expectation, management must execute flawlessly on their internal cost-cutting initiative, ensure that their newly constructed production facilities maintain maximum capacity utilization with unscheduled downtime, and successfully close their planned asset monetization deals to sustain their cash runway. If they hit these targets, it will validate the current turnaround narrative and could trigger a sustained institutional re-rating, moving the stock away from a pure retail trading vehicle into a legitimate option for specialized clean energy funds. However, the reality of the risks ahead cannot be overstated. The clean hydrogen industry is deeply dependent on government regulatory frameworks and subsidies, particularly tax credits designed to incentivize green energy production. Any delays in the final implementation of these rules or political shifts that threaten to scale back clean energy incentives would immediately destroy the financial assumptions underpinning the company's long-term revenue models. Furthermore, the company still faces a highly constrained liquidity profile. If their operational cash flow does not improve as rapidly as projected, they will be forced to return to the capital markets for additional financing, leading to further equity dilution that would cap the upside potential for current shareholders. Investors must look past the superficial daily price fluctuations and constantly evaluate whether the operational metrics are genuinely catching up to the grand structural narrative, or if the market is simply experiencing another temporary wave of speculative enthusiasm. In summary, the central tension dictating the price action of this clean energy pioneer is the ongoing battle between the optimistic narrative of an operational turnaround and the structural realities of a capital-intensive, pre-profitability business model. While the recent first quarter financial results provided genuine signs of operational progress through increased electrolyzer shipments and improving fuel margins, the sharp intraday reversals remind us that institutional capital remains highly skeptical of the long-term sustainability of this growth. Speculative volume driven by retail platforms creates frequent short-term trading opportunities, but without a fundamental shift towards organic, self-sustaining free cash flow, the asset will remain highly vulnerable to macroeconomic pressures and market-wide liquidity contractions. True clarity will only arrive when the company proves it can operate with continuous capital injections, making it essential for market participants to separate short-term headline momentum from the cold reality of balance sheet execution. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, upload with your friends, subscribe for more updates.